So, Chapter 19 really represents the completion of the journey from the United States recovering from the Civil War and setting the groundwork for a developed economy. And so, here, what we're looking at are basically the financial system. How does the financial system evolve in the United States after the Civil War? If you remember, up to this point, what was happening was that we had after some debate, the first Bank of the United States and then the second Bank of the United States, both of those being formed at around the first bank being formed at the country's founding, and then the second bank being formed in the 1820s. Congress had the authority to make coins. The states, they weren't authorized to print their own currency, but they could authorize the formation of banks that in turn could issue currency. So the result was that before the Civil War, in the years leading up to the Civil War, you had no national banking system and a largely decentralized regional banking and even currency system. It changed in the Civil War with the establishment of a national bank and the national bank in turn issuing currency. Those national banks were under national regulations, and that's basically what we're going to look at here now, is what happens after the Civil War. So, what defines the economic system basically between the Civil War and World War I, which again is basically the postbellum period, was we had many banking panics. Banking panics are usually represented by everyone basically getting scared that they're not going to be able to get their money out of the bank. And it also generally is a banking panic would be represented by the fact that you can't even borrow from the banks. Not only are the banking panics hurting things, but for basically 3 decades after the Civil War, you have among the worst economic problems that one can have, which is falling prices. Now, that may seem odd to you that falling prices would be a bad thing, but what the negative consequence to falling prices is that much of the economic system is not built on your wage falling over time or prices falling over time. In general, when we borrow money, for instance, the loan amount doesn't go down. We just have an economic system that's not really set up for prices falling. And the individuals that are hurt the most by these falling prices are farmers. And then you get these quite severe economic depressions in the 1870s and again in the 1890s caused by these banking problems and these falling prices. And it culminates with a banking panic in 1907. And that banking panic in 1907 actually is what gives rise to what we'll talk about in the last slide when we talk about the formation of the central bank that we have today in the United States, the Federal Reserve. But also at this time too, not only did you have an economic and a monetary system that had flaws, but you also had an economic system. You also had an economic system that wasn't providing enough capital for basically these growing industries. So the industries needed the growing capital, and it was with that they were going to be able to grow even further. So industry up until this time basically had to borrow from European banks, which were much more established. Additionally, what we see here is the United States was essentially operating under the gold monetary standard, as most of the other countries were. And what the problem became with this gold standard was that the gold was basically leaving the country because it was being used by individuals to buy goods that were imported from Britain. So because all the gold was leaving in the international trade purposes, the government and banks stopped gold payments in exchange for currency. At the same time, the United States government, the North, basically needed more money to be able to finance the war. And so the net consequence of that was that the National Bank Act of 1863 was passed. And that what this did is it created the national banknote, what's today known as the greenback. Although I don't know very many people that call the U.S. dollar the greenback. It was its original nickname because of the green print that exists. Now, because banknotes could be issued by these national banks much more, you had the money supply increasing and prices increased. And these greenbacks, these national banknotes, basically solved two problems. They gave revenue to the government that was needed during the war, and it gave us a national currency that could be used for national transactions as the country was being unified after the Civil War. And at least to some extent, it didn't solve the problem, but it did make the problem less of a problem with deflation. Right? Because if you're printing lots of national banknotes, that will reduce the deflation that was happening. Now, here's an example right here, which is actually from Hawaii. It's a pretty well preserved note. This would be a $10 note that was from the territory of Hawaii. And this would have been the national banknote that basically you could have used across the United States. Not only Hawaii as a territory. As you can see here, you don't really see as much green, but you do see the beginnings of the note that we would all recognize today. As you'll notice, the note is pretty wide, so it doesn't have the shape exactly of what we would see today. So I didn't change the width or anything. This is the actual width. So it's more like a strip than it was anything else. And what you'll notice as well in this note is that it basically, what gave this note any value and made it a true national banknote was the fact that it was secured by this bank having bought U.S. government debt. So what this bank would do is it would use some of its deposits and it would buy U.S. government debt in the form of bonds, and then it could issue as much currency as it bought those bonds. And that is basically what secured this note. And that's what we see right here. So this really then becomes the banking currency from 1863 to 1935. Not all banks were national banks, but those that were had a federal charter, and as I said, they would use their deposits to buy bonds, U.S. government debt basically, and then it would make a currency, a banknote, and it could issue banknotes that were up to 90% of the value of those bonds. And in return, what gives trust to those national banknotes is the fact that the federal government is backing them. Basically the bonds. Now you can only issue as many bonds as you have, government debt basically. So that's all the banknotes you can issue. So you're going to get some inflation, but also part of the problem is that after the Civil War, the government actually takes a pretty strong the government takes a pretty strong track on reducing the amount of debt it had. And so by doing that, it does cause part of a problem. That problem being that the size of the currency starts to fall. Now, what you can see here, and this is from the book, what you can see is that national banknotes are growing in size here. Gold coins are still useful, silver is still useful, but the national banknotes are going to become important. At the same time as you have the national banking system, you also have the state banking system, which was allowed to continue to exist. And that state banking system, the government, the national government tried to do everything it could to make state banks die, and it really couldn't. So the national banking system was more sound. There were legal reserve requirements. By that we mean after you make a deposit, that nationally chartered bank had to deposit some of its deposits into bonds. That was U.S. government debt. So you knew your deposit was safe. Whereas state banks are just issuing currency, but then they can make loans, and those loans can go bad, and the state bank will fail. So the national government then tried to make it so that state banks wouldn't issue that many notes, and that their notes would then not become deemed as valuable as national bank notes, and that there'd be, without pushing people to the national banking system, people would have an incentive to have the national banking system. And so there was a tax placed on state banknotes, starting at 2% in 1864, and then growing to 10% in 1865. But even despite the fact that there was this 10% tax, people didn't go away from it. The state banking system did not die. In fact, it still exists today. At some banks are actually regulated by the state instead of the Office of the Comptroller, which is the national banking system regulator. And that was just basically because of the stricter restrictions. State banks could do a lot more things. And depositors didn't necessarily highly value the fact that some of the banks didn't have a national charter. People seemed to still be okay with using the state banking system. And so because they were, well, then you can't really do too much about it. Except allow the two systems to coexist. And you see this here. That, if anything, the national banking system is growing, but the state banking system is flourishing. And, as you can see here, by the end of this postbellum period, up to the point where the United States enters World War I, the state banking system is larger than the national banking system. But what you should also see in this, as opposed to just state versus national, is that the entire banking system is becoming larger. And that's actually a good thing. And it's a sign that the economy is becoming more mature. That you have a domestic, that you have a strong domestic banking system, a system for capital internally to the country. The currency is where we have many of the problems. Because the currency we had this uncertainty, is whether we were going to have a gold standard, a silver standard, or no standard at all. The fiat money, which in essence was that national banknote, didn't have any inherent value except the U.S. government saying, "Dude, you'll get your money. Don't worry, we promise." Which is essentially what we have today, is a fiat money system. The U.S. dollar has no intrinsic value. There's no asset behind it. Additionally, what you see is a debate, a pretty strong debate between a gold standard and a silver standard. And this actually does cause a bit of a problem that no decision was made. There was a number of individuals. The Republicans wanted to return to the gold standard in a movement away from the fiat currency because they were concerned about the U.S. government issuing too much currency and about the inflation that would exist, and that also by having a gold standard that the credit rating, basically the credit score of the United States, would increase. And their argument did, at least informally or unofficially, was was what we had. It was a system where you could, for the most part, convert your notes into gold. From about 1880, basically, to the turn of the century. But one of the problems was that because of basically an administrative error, a typo, the silver was actually no longer considered an official currency. So it was demonetized. And it set up a debate where farmers and people on the frontier wanted silver because it was more plentiful, and they wanted to create inflation because they were hurt so much by the deflation. But again, those who were rich and those who were in power wanted to keep the gold standard present. That debate culminates in the 1896 election, where, as I said, William Jennings Bryan makes this kind of famous speech where he says that you won't sacrifice us on this cross of gold or something along those lines. Well, William Jennings Bryan is basically is very left, very liberal, and he's calling for a silver standard because it's going to help the people and it's going to create inflation. He was a populist. Now, he doesn't win the election. He doesn't win the 1896 election. But what's interesting is that many of his policies are actually taken up by Franklin Delano Roosevelt, who we'll talk about next week when we get to the New Deal and the Great Depression of the 1930s. That election, finally, in 1896, pushes the country to finally formally adopt the gold standard in 1900. It actually then gets dropped with the election of Franklin Delano Roosevelt in 1933. Is when the United States, for regular consumers, officially goes back off the gold standard. But one of the conclusions of many macroeconomists, mainly Anna Schwartz, is that you basically had 40 years where we should have just decided gold standard or silver standard or nothing at all. It was that uncertainty that caused a lot of problems and did delay the United States from becoming a developed country even a little bit sooner. So, one of the other things that happens in this time is that investment banking grows. Now, it had started during the Civil War. We had quite a bit of we had the beginnings of investment banking as government bonds were sold basically door to door to help finance the Civil War. These investment banks are not issuing currency like the European investment banks are. But what it did is it allowed the large industries in the United States, like the railroads, like large manufacturing businesses, to be able to get the currency that they needed, get the capital that they needed. And the other thing that's happening too, as I said, was that the government was paying down its debt after the Civil War. And so one of the things that this created is it pushed people to basically start to invest in stocks and bonds, because what else could they buy, essentially? So investment banks had a product that others now wanted. Now, what we have then, in 1900 and around that time, is you then basically have a banking system that's grown, both on the national level and on the state level. You have a uncertainty about what's going to back up the currency, but eventually it goes to the gold standard in 1900. You do have banking panics still, because of the fact that we have both the state and national banking system. We have this deflation, and unfortunately, or fortunately, it all comes together in 1907 in a bad way. And it comes in a bad way with the banking panic of 1907. And it was pretty bad. As I said, because the U.S. government wasn't issuing as much debt, then all these other stocks and bonds were out there. And with that, you had basically bubbles. You had basically too much money chasing some pretty bad investments, and they basically blew up in 1907. And as banks failed, there was no central bank that could bail them out. And so you have lots of state banks failing. And the only thing that could save the banking system, because there's no central bank in the United States, the only thing that could save it was basically two very rich people, J.P. Morgan and John D. Rockefeller. And the president at the time was Theodore Roosevelt. And Theodore Roosevelt basically really hated rich people. And he was worried about the government and the United States society basically being run by rich people. So it concerned him. And he essentially said that we need a central bank. We need a Federal Reserve system that's going to be able to bail out banks if needed. And the government needs to get more involved in regulating banks, which the Federal Reserve system does. The Federal Reserve does regulate all banks, whether they are nationally or state chartered, to this day. And the Federal Reserve system lends to all banks, whether they are nationally or state chartered, which is what we see today. And one of the realizations for this banking panic was that also the government, by politicians basically making the banking regulations, they actually caused or at least encouraged this panic as well. Because what they did is they told banks they didn't have to buy government bonds anymore to be able to issue currency. And they didn't have to hold any reserves. And so banks basically overlent, or they overlent money, thus causing the panic and causing these speculative bubbles to exist. It gives rise to the Federal Reserve. So it represents the third and our current attempt at having a central bank. Because of the debate that and the compromises that were required to create the Federal Reserve in 1913, is it has both public and private elements. The Federal Reserve is actually owned by banks in each district. And the Federal Reserve is basically divides up the United States into 12 districts. My former employer was actually the Federal Reserve. I worked for the 7th District in Chicago. We here in Hawaii are in the 12th District, which is based out of San Francisco. And so the Federal Reserve District Bank is owned, the shares of that bank are actually owned by the banks in that region. Yet it obviously has a public role as well. It serves all of the banks, and it provides services to make the banking system work well, to make it work smoothly. The Federal Reserve System, as it was set up, as I mentioned, didn't get rid of the state banking system, but the Federal Reserve System certainly is going to regulate everything on a national basis. And what the Federal Reserve does, that's an improvement over the banking system that existed previously, is it gives some authority to actually controlling the money supply and controlling inflation. And it's giving that uniformity to the regulatory structure outside of politics. But the Federal Reserve is not printing cash. That's actually still what the government does. So the government is just issuing cash, and it can issue as much or as little cash currency as it wants to. But the true money supply is determined by the Federal Reserve and its ability to create money by buying and selling U.S. government debt. And so this central bank, the Federal Reserve, the only thing that's kind of lacking at this point is that we're still under the gold standard at this point with the currency. That's going to be resolved in 1933 with the Great Depression. The United States is going to go off the gold standard, and so then we're just going to have currency existing. But what this does as well with the Federal Reserve is that state banks then no longer are issuing currency. That's going to be what the national government does. And so this is what a developed economy needs to be able to exist. And it's with World War I, which is the event that happens directly after the Federal Reserve is created, that gives us the beginnings of the modern economy the United States is a developed country, the economy that represents at that point.